Every year, Wall Street banks tell you that the Indian stock market is a bubble because it trades at 22 times earnings. Yet those exact same banks are happily paying 27 times earnings for US stocks and calling it an attractive revolution. Why is an expensive American market a structural shift, but a cheaper Indian market a dangerous bubble? Hello everyone, and welcome back to the channel. Today, we are exposing the valuation hypocrisy and explaining why Wall Street's models are completely broken when it comes to India. Every year, global strategists release reports telling clients to downgrade India to underweight and wait for a massive correction that never actually comes. Let's dive into the math and see why they are dead wrong. 1. The double standard. Right now, the S&P 500 is trading at nearly 27 times earnings. This is significantly more expensive than the Indian market. Yet Western strategists label the US market as attractive or overweight. They justify this massive premium with buzzwords like the AI revolution or American exceptionalism. This is the definition of a valuation double standard. It is a bias that ignores the fundamental mathematics of investing. Price is what you pay, but growth is what you get. 2. The reality check, the PEG ratio. To understand why Wall Street is wrong, we have to look past the simple PE ratio and look at the PEG ratio, price earnings to growth. This is the great equalizer of valuation. The US market demands a 27x multiple for corporate earnings growth that is projected to be around 10%. This gives the S&P 500 a PEG ratio of nearly 2.7. In investment terms, that is undeniably expensive. Investors are paying a premium price for moderate growth, banking entirely on the hope of AI. In contrast, the Nifty 50 trades at roughly 22.5x earnings, but corporate earnings in India are projected to grow at 16% annually over the next 2 years. This results in a PEG ratio of roughly 1.4. In pure mathematical terms, Indian stocks are offering growth at a reasonable price, while US stocks are offering growth at a premium price. The math favors New Delhi over New York, yet the Western narrative remains stuck in the past. 3. The scarcity premium. When confronted with this math, the Western defense is usually about quality. They lump India into the same emerging market basket as China, Brazil, or Russia. Markets that are slowing down or dealing with massive geopolitical risks. But the reality is that India has decoupled. In a global landscape where Europe is stagnant and China is battling deflation, India is the only large economy consistently delivering 6.5% to 7% GDP growth with a stable currency and a robust democracy. This isn't just a cyclical boom, it is structural scarcity. In a growth-starved world, India offers stability, and that stability deserves a scarcity premium, not an emerging market discount. 4. The domestic wall. Finally, Western models fundamentally misunderstand the new structure of Dalal Street. Their models are stuck in 2015. They assume that foreign institutional investors, FIIs, are the sole drivers of price. They completely fail to account for the domestic wall, the massive $3 billion entering the Indian market every single month through retail SIPs. This domestic liquidity creates a permanent floor under valuations, preventing the deep corrections that Western analysts keep predicting. The Indian market isn't expensive because of a bubble. It is expensive because the demand for high-quality Indian equity simply exceeds the supply. Smart money is starting to see through this bias. They realize that the expensive tag is just a lazy shortcut used by analysts who haven't updated their models in a decade. So the next time you hear a downgrade from a global desk claiming India is too pricey, check the price tag on their own home market. They are happily paying 30x for a US tech stock while scolding you for paying 22x for the fastest growing major economy in the world. The math is on India's side, the bias is on theirs. Invest accordingly. If you found this breakdown helpful, please hit that like button and subscribe to the channel for more no-nonsense financial wisdom. Thanks for watching, and see you in the next video.